Well, good afternoon, financial professionals. Abby Fletcher here of E4 Insurance Services, welcoming you to the BREW, building relationships every week. Thanks for tuning in today. For those of you joining the BREW for the first time, we like to start the BREWcast by celebrating today's National Day for September 9th. First up, it's National Teddy Bear Day. This one dates back to 1902, when President Teddy Roosevelt, who was known for being an avid hunter, was on a hunt and his companions lassoed a black bear, and encouraged him to take a shot. To which he replied, "I couldn't be proud of myself if I killed an old tired bear tied to a tree." The news of his compassion traveled throughout the US, and this inspired a toy maker in Brooklyn to create a stuffed animal that they dubbed Teddy's Bear. Today, we celebrate this lovable toy and the softer side of the president that inspired it. Also, this Sunday is National Grandparents' Day, encouraging you to give some extra love to your grandparents. Perhaps bring them a teddy bear. Today on the BREW, we have the Andersons, our very own Bill Anderson, who serves as our wealth strategist here at E4 Insurance Services, along with Steve Anderson of Pension Quote, who serves as marketing director and advanced insurance designer. They'll be sharing ideas and details on cash balance plans and their many benefits in the business owner space. Feel free to use the chat box to share your thoughts while the Andersons are live. I'll be keeping an eye out for your questions so that they can provide real-time answers. Also, all attendees are in a drawing for a prize, and we'll be announcing the winner shortly, so stay tuned. Thanks for tuning in, and without further ado, Bill, welcome. The mic is yours.
Thank you. Appreciate that, Abby. I guess I'm one of the resident experts here at E4 in regards to cash balance plans. In the last, call it 12 or 13 years, I've been part of 70 to 80 of these plans. To me, it's very important that you have a TPA involved inside of one of these. There are opportunities out there in the marketplace to do a cash balance or a split funded defined benefit plan, which it's also called, without a TPA. But that's too much risk, especially in the fiduciary world and place and space that we fit in today. The TPA takes care of all of that piece. Steve and I have worked together, what do you think, Steve, 5 or 6 years now?
I think, yeah.
He was with a different firm. I went to Pension Quote a number of years ago, and I'm like, I'm coming with you. I really enjoy working with Steve, and really the best part of Steve, and he's got all these designations and professionalism about him, but the bottom line is how he connects with your clients and how he connects with your clients' tax advisors is incredible. He just gets it to a level where the CPA is talking to the CPA at that level that they speak at. And it's a special honor to introduce you today, Steve, and I'm just going to ask you to run with this. And I know we have a limited amount of time, so go.
Very good. Thanks, Bill. I appreciate it. Abby, you don't know this, when you started the Teddy Roosevelt, if I could swing my camera around, there's I've got a bust of Teddy on one of the bookshelves. So I've always been a presidential fan, so I like that. And what we're going to do today, we're going to talk about cash balance plans, but I'm going to give you some ideas of how you can talk to your clients, how you can present the concept to them. Bill and I will take care of all the details. You don't have to be an expert in the program at all. If you bring us the client, we'll get the situation and tell you whether it fits, whether it doesn't fit. So we're happy to do that. And so with that, I think for a current topic today with is the debt in the United States. How's it going to be funded? We were seeing the Congress spending money like they have it or something, they could print it. But what's the impact of that? It got me thinking about where the debt is. And I think it opens up a real case for cash balance plans, also opens up a case possibly for LERPs and other insurance sales. But let's go through that. And if you look at the debt in the United States, how's it going to be funded? And what does that debt look like? And if we looked at the debt as of the start of the fiscal year, which is October 1st of 19 is when the 20 years started with the government, we had $23 trillion U.S. national debt. We had $1 trillion of state debt and $2 trillion of local debt. So we're looking at $6 trillion of debt today. So what's it going to look like down the road? If we look at the budget this year, we were projecting $3.5 trillion of revenue with $4.5 trillion of spending. So we were going in the hole another $1 trillion without spending any additional money. That was pre-COVID. So what happens, what happened? We've been spending money. What was the course there? Look at how big the COVID response was. If we look at what they've authorized to do, about 3.6 trillion, this is from about a month ago from CRFB, but they were looking at about 2.4 trillion. We're easily going to go over $3 trillion more. So we're approaching, it was 27 trillion before we added the other end. We're going to be close to $30 trillion of deficit that the government's got. So that's the debt they're going to have to be paid back. Who's going to pay it back? Obviously, it's the taxpayers. The U.S. taxpayers are going to pay it back in one or two ways, either income tax or state tax. Hopefully we don't pass it to our, grandchildren or great-grandchildren, but it's somewhere that's going to have to happen. And even with what's going on now, if you look at the, this out of the way, presidential candidate Biden is proposing to roll back all of the taxes that occurred in the Tax Relief Act a couple years ago, and also add a 12.4% tax on people over $400,000 of income. So taxes are going to go up from an income standpoint. Now we don't know. It doesn't really matter whether Biden gets elected, Trump gets elected. Either one, somebody's going to have to start to deal with the reality that this bill, this tax burden that we've got, the debt, is going to have to be paid back some way. So your clients are going to be looking and saying, hey, I need to save tax dollars. I don't like the fact that we're paying too many dollars in taxes. What can you do to help? The reason that this works is the tax dollars that they're saving. That's the thing. They're also going to look and say, how do we save retirement income as economically as we can? There really are two categories, if you will, of qualified retirement plans. I look at it as like two silos, two different kind of plans. The ones we know the most about are defined contribution. That's where we can save $19,500 in a 401k. A lot of business owners know what that is. They understand that. But the limit there is the most they can get in, no matter how much the money they're making, is $57,000. And the other thing a lot of business owners don't want to do is when they put that money in there, they're putting the same percentage in for all the employees. It just doesn't seem to work very well. You don't see very many overly funded profit sharing plans when they've also got employees. The other silo, if you will, is defined benefit. And that's where cash balance lives. It's part of the defined benefit law. It's not something new. It's something that was started back in the 1930s. So it's been around a long time. And what we do there, we can solve for a maximum benefit for them at retirement of $230,000. So the tax code doesn't tell us, here's how much money you can put in every year. What the tax code says, you could do a benefit for your client where they would get $230,000 for life. The earliest they can do that is age 62. And it roughly works out to, $2.9 million, a little less than $3 million they can accumulate at 62. Now, I look at it and say it's a math problem. You saw how many years there is to 62. It's supposed to be moderate returns. So the government, the Department of Labor gives us a guideline of 5% return. So you're not looking at this as a home run type return, but something that's solid and steady and they should be able to bank on. So it's a little more than that. I give the actuaries credit. There's more things you have to figure out, but that's basically what it looks at. And we're looking at how much money they can actually put in when they do that. The advantage, there's higher contributions. One of the disadvantages that people often say is, well, it's permanent. It's supposed to be there forever. And that's true. They don't give us an exact date or a number of years, but it's basically 3 to 5 years is what it's supposed to be enforced to be considered a permanent plan. And so we just make sure that it happens, but we have a lot of flexibility there. We have a lot of flexibility in what they contribute. There's a lot of places that we can move that up and down. So don't think about when it's permanent, it has to stay. If they're putting 200,000 in, that's same amount forever. We have flexibility. We're going to design it that way for you. And that's probably goes to today about the details of the plan. Don't worry about the details. And if you want to get more specific about it, call Bill, call me, and we'll walk through them for you. But there's really 5 reasons they work. Taxes, that's the main reason. That could probably be the top 3 reasons. But they're looking to save taxes. You're looking at your prospect is probably making $500,000 plus a year in income. That's probably where the most of them are going to be. Some are less than that, but that's where a lot of them are going to be at. They can discriminate in contributions. Often you get a partnership going. I think of doctors. We've had doctors, 5 doctors, where they were in a plan. We don't have to have every doctor covered. The tax code, the Department of Labor code says we have to have 40%. So we don't need all 5. The other thing that happens, you're going to have one of the doctors that's a saver, that's putting away a lot of money. Somebody else is spending a lot of money. We can adjust for that. So just think about, there's a lot of discrimination we can do. If they've got an employee who's making more than $130,000, maybe they got a certain branch that's doing more than that, we can eliminate those people. So there's a lot of ways we can do, and every plan's custom designs. There's not a cookie cutter, everybody gets the same thing. We listen to it, figure out what they want, and try to match it with it. The other thing not to pass over is creditor protection. So when they're putting a couple $100,000 into this plan, it's creditor protected. That's true with any qualified plan, so it's not specific with these, but it's something to remember because a lot of the business owners are concerned about qualified plans. About creditor protection. They don't want to be sued and need the protection from that. Bottom line is they can do different things. They can do different things that might give them a tax deduction. There's actually a retirement account there. So there's something that's actually there. One thing, and we'll look at some individual plans and some samples. I think people looking at this year and say, well, Steve, is this a good time to start it? Because boy, there's businesses that are suffering. What I'm finding, there definitely are. There's some people we have to have compassion for that are having a tough year. There's also people that are having a great year. One of the things I've had 2 in the last 2 weeks now of people that are, they spray for insects, Orkin. Just had one in St. Louis this morning we talked to, that's an Orkin distributor. His profits are up 30% this year. Now, I don't know why exactly, but talked to somebody in Michigan last week, had the same situation, they're making more money. So there are people out there, there's businesses out there that are making money and looking away for saved taxes. So if we look at just the contributions, we're gonna look at a 49-year-old business owner. We know they can put $6,000 in an IRA. The one they see the most of is a 401k at 19.5. Most business owners, if they're making $500,000 and you're showing them a way to save $19,000, it's a drop in the bucket. It's not really solving their retirement problem. Doesn't save them any taxes compared to what they're making totally. Somebody who's making $100,000 and put 19.5 into a 401k, they're in great shape. But if somebody's making $500,000, that's not enough money. If I look down to that defined benefit plan, you can get up to $225,000. So it's a lot of difference, a lot more money they could put into the total plan. Look at some cases, some examples. 2 dermatologists, 52 and 55, they're putting $41,000 a year in. We were able to and putting $30,000 in for employees not happy with the plan at all. Show them where they could put $200,000 a piece, and they only increased their employee contribution $10,000. So they went from 30 to 40. Trying to get through all of this in our time frame. Life insurance. Why do we put life insurance in there? A lot of reasons for it. It's the only place you can put an asset in there, makes it income tax deductible. And if they were to die before the plan is finished, it completes the plan, but also those proceeds come out tax-free. Big difference. The real reason they look at life insurance as a plus is that life insurance gets them about, depends on their age, roughly 25% more contribution ability. So they're looking and saying, how do I maximize this whole program? We can do it with by putting life insurance in there. Okay, what do we do now? So I know we went through this pretty quick, just give you a brief, quick overview of what the whole thing looks like. But you might be sitting there saying, do I need to know all about pensions to sell these plans? No. What you need to do is to find the prospect, find out who works, who will work with this, who's that person that's between 45 and 65. They're complaining about taxes. The accountants are a great source for who's complaining to the accountants about their tax bill being too high. Most accountants don't have a solution. Here's a solution for them. Here's a solution that they can put money into their account, their qualified account, and save tax dollars. So what do we need to do it? We need a complete census. So if you get a hold of Bill or myself and ask us, we'll get you a census, get a form, we'll look at it, we'll talk you through it, we actually will go there, and in the past we've gone there more. Now with COVID, we're doing more of the video conference type things. But here's the contact information for both Bill and myself. More than happy to answer any questions, but try to keep you within your 15 minutes, Abby. How do we do? We're close?
You're doing great, Steve. Thanks. Okay. I've opened up the line for questions from the audience. Now is your time. I had a question come in, Steve. Is there likelihood for companies that participated in PPP dollars? Would they be great candidates?
It could be. So you really look at the PPP will actually gave them more dollars to help pay some bills this year. So they definitely could be a good candidate. And what we will look at, one of the things, the clues that we're going to look at, Bill and I look at, is when we look at this plan and say how many dollars can that owner contribute, what we want that to be is 75 to 80% of the entire contribution. So if they're going to put 200,000 in, we're going to try to keep that employee costs, if we can keep it to $30,000 to $40,000, we know they're going to like that. So the PPP could definitely be somebody that might be able to take advantage of it.
Excellent, excellent. Any other questions from the crowd?
Steve Dan Peterson, what does the tax filing status of the entity of the employer matter in these combination plans, pass through versus?
Yeah, that's a real good question, because really a lot of people don't know that, because some think it has to be a C Corp or something. It can be any kind of entity. So it could be a pass-through, be a C, an S Corp, LLC. We can set it up with anybody. So that it doesn't matter. They could be a sole proprietor and they could still do it. Probably the best candidate is that consultant or somebody that has 0 employees. They can set it up for themselves. And they also are going to get this plan. I mean, we do the combination. We're going to do the 401k, profit sharing, and the cash balance. So they put it all together.
And for those who manage money in our group here that are on the call, it's not just a life insurance component. They also can manage the assets, correct?
You're exactly right, Dan. So that basically, if we put in the money, roughly 40% is probably going to go into life insurance. 60% is going to go into an asset. And again, moderately, so a lot of it's in managed money, and the advisor is going to manage that money totally.
Thank you.
You're welcome.
Excellent, excellent. Any others from the crowd? Well, thanks for sharing, Steve and Bill. Steve, as our guest speaker, I'm going to ask you to look into your virtual top hat and give me a number between 1 and 22.
1 and 22. Okay, so we're going to look at 15 is a good number. So we're going to give the number 15 is going to be your winner there.
Excellent, excellent. Who's the winner? Who's the winner? Ooh, the winner today is Jonathan Craning. Congrats, sir. Be on the lookout for a Starbucks gift card coming your way from all of us here from E4 Insurance Services.
Congratulations, Jonathan. Thanks for congrats. I appreciate it. And give Bill or myself a call if you have any questions.
Excellent. Thanks, Steve. And be sure to tune in next Wednesday for the Brew. We'll have Doug Bowden of Symetra discussing even more business planning strategies as well as premium finance. Thanks, friends. Make it a great day.